All right, we saw a positive start for stocks on this Monday morning. We mentioned a couple of key themes. One is that China reopening trade. Another is a growing belief that perhaps the U.S. Federal Reserve is going to be in a position where it can at least take a pause on interest rate hikes. Obviously, all those rate hikes in 2022 really weighed on the markets. For a broader look at 2023, let's bring in Kathryn Rooney Vera. She's head of research and chief market strategist at Bulltech Capital Markets. Happy New Year. Nice to have you with us, Kathryn.
Thank you, John. Happy New Year to you.
What are you thinking about as we kick off a new trading year?
I'm really thinking about the labor market. I was very convinced, John, that it would be very difficult for the Fed to get the 2% target without the labor market at least slightly rolling over. But after talking with Claudia Sahm and reading some of her pieces, of course, of the Sahm rule, I'm really wondering if, in fact, John, this time actually could be different. And we don't need to get unemployment to really move a lot higher to get inflation here in the U.S. back down to 2%.
So that's an interesting comment, because it feels like most people, I mean, this is very anecdotal, but most people came into this year with a relatively bearish tilt because of what we just saw, in 2022, and B, because the jury is out on the inflation front. But you're saying that you're feeling a little bit more conviction on the ability for both inflation to come down and for perhaps central banks to at least take their foot off the pedal, I suppose, with interest rate hikes, and for the economy to also navigate through that relatively well?
Oh, John, I was certainly, and still am, in the more bearish camp. I think that a recession is a natural part, or in fact, it is a natural part of the economic cycle. And I do think it's coming. From stagflation, we're more likely than not going to enter into the next phase, which is recession, meaning that economic growth decelerates to the point of contraction, bringing with it inflation. It's just a natural part of the economic cycle. So I am still in that camp that I think we get an economic contraction. My principal focus now, and continues to be over the past year, it has been, remains the labor market. And I wonder if the data that we're seeing is truly sustainable or not, which is, in fact, that prices are, we're getting disinflation, so inflation is still high, but growing at a slower pace, with a labor market that we saw last week, John, is still very robust here in the U.S.
It definitely is. Okay, so let's get to the action plan then. So how, in terms of the portfolio strategy for 2023, how do your macro views factor into your investing views?
Well, I still think there's a lot of risk to the downside. That's why I like cash and cash equivalents. I know it's boring, but I think it makes sense right now because, as I say, there's a lot more, in my view, downside to potential upside right now. So you can look at T-bills or commercial paper or short-term investment grade notes. They're all yielding in very short duration. I mean, 4.5% to 5%. We're talking 3-month, 6-month treasury bills, commercial paper, short-term notes. There really is an alternative now to equities. And I think that's in fixed income. And I think that's where we want to be positioned, as well as if we are in equities, in dedicated equity space. John, I think it's a very smart idea to be in the defensive sectors that historically outperform not only in stagflation, but in recessionary environments.
We had a guest on earlier, Kathryn, who shared some of those cautious views, but also tried to balance things out with the what if. What if there are some signals out there that worst case scenarios are avoided, and then you see some kind of pop in the stock? Are there any concerns, I guess, in your positioning that you might miss out on that opportunity if sort of the macro story or the headlines start to change faster than we might have thought?
Absolutely, John. And that's why really on my short-term radar are sectors that historically outperform when we do get that switch, that inflection point in the economic cycle. We're not there yet. So I'm cautious of those analysts and those people in consensus that are already discounting recovery before we've even gotten through the recession. Maybe we don't even get a recession, maybe. But to price in something that happens after recession, which isn't even occurring right now, I think is kind of jumping ahead. So the sectors that I'm looking at, if in fact we do avoid a recession, if in fact by some miracle the Fed is able to hit the 2% target without forcing a contraction or a deceleration in demand, lower, higher unemployment, would be the sectors that did the worst last year. For example, small cap US, small cap Europe, banks, real estate. These are the sectors that I think could get a big pop if in fact things pan out to be a far better scenario than I'm envisioning.